Hey there investors and welcome to our channel. Today we're going to dive deep into one of the most important financial companies in the world, JPMorgan Chase, ticker JPM. JPMorgan isn't just any bank, it's a giant, with top-notch operations in almost every part of the money world. From Wall Street to Main Street, it's definitely the biggest bank in the United States. But in such a tough and up-and-down business, what really keeps it so strong? Is JPM an unbreakable fortress like many think? Or is its huge size actually its biggest weakness? In this video, we're going to do a full review of why JPM is a good investment. We'll break down its plan, its different businesses, what makes it special, its money numbers, the risks, and what both the bulls, those who think it will go up, and the bears, those who think it will go down, are saying about the stock. Our goal is that by the end of this video, you'll really understand how JPMorgan works, so you can make your own smart investment choices. Let's get started. Strategy and dominance. The Colossus's strategy. To understand JPMorgan, you need to grasp its main strategy. Being big and having many different things going on, JPM is a leader in almost all these areas. While other banks have tried to do something similar, few have managed to make all the pieces work together so well. Being big makes things more efficient, and having many different things going on reduces risk. But JPM isn't just sitting still. The people in charge know that technology and being big are becoming super important. That's why, since 2022, the bank has started spending a lot of money on new things, and this will likely continue until at least 2026. What does this mean in real life? 1. Growing internationally. They're looking at certain countries like Germany, focusing on online tools for all kinds of banking services. 2. Growing naturally. They're hiring more financial advisors and bankers to get more customers. 3. Building an ecosystem. JPM doesn't just want to be your bank, they want to be part of your daily life. They bought a travel agency, a website for restaurant reviews, The Infatuation, which owns Zagat, and technology for loyalty programs. The idea is to create a whole system of things you use that will bring in and keep more customers. And of course, there are the smart purchases they make when opportunities pop up. The most famous one was buying First Republic Bank in 2023, when other banks were having problems. JPM stepped in, bought a failing bank for what was a really good deal, and instantly made their wealth management business much stronger. Of course, being so big has its downsides. JPM deals with more complicated rules, more watchful eyes from regulators, and has to keep more money in reserve than its competitors. We'll talk more about that later. But for now, their plan is clear. Use their size, and how much money they make to invest more than all their competitors, and get even further ahead. Business X-ray. JPM's profit engines. JPM's diversity is its big strength. Let's break down the main business lines. Subsegment 1, Retail and Commercial Banking, the Main Street giant. This is the bank most people know, and the numbers are amazing. Market share, 11.3% of all retail deposits in the United States. It was 7.5% in 2013. Reach, over 80 million consumers in the United States use one of their products. Credit cards, a powerhouse. It holds 23% of the credit card sales volume market. The engine here is synergy. JPM gets low-cost deposits, cheap money from retail, and lends that money at higher rates in the credit card business, which is super profitable. Subsegment 2, Investment Banking and Trading, the King of Wall Street. This is the Corporate and Investment Bank, CIB. Here JPM is the one-stop shop for the world's biggest companies. It's important to note a key difference: investment banking, advisory. The competitive edge here comes from intangible assets. Reputation, relationships, network. This attracts the best talent and the biggest deals. JPM has a leading 9% share of global investment banking fees. Trading. Here, the advantage is smaller. Markets are clear and electronic, which squeezes profits. It's a volatile business that needs a lot of capital on the balance sheet. Even so, JPM's size lets it spread out fixed operating costs over a huge number of transactions. Sub-segment 3, Asset and Wealth Management, the Wealth Manager. This segment, Asset and Wealth Management, is about managing other people's money, from big pension funds to super rich individuals, ultra-high net worth. The numbers are impressive. JPM is the 5th largest asset manager in the world, with over $4 trillion in assets under management. The competitive advantage here comes from two things: brand and performance. The JPMorgan brand builds trust, and their funds have a good track record. Switching costs. It's hard for a client to change managers. There's a comfort level, a trust in the advisor. JPM really strengthened this area by getting the high net worth clients from First Republic. The competitive advantage. JPMorgan is said to have a wide competitive advantage. This means analysts believe the bank can make more money than it costs them for over 20 years. But where does this moat come from? There are two main reasons: cost advantage and switching costs. And everything gets bigger because of one thing: scale and scope. 1. Cost advantage. JPM can get money cheaper than its rivals. Its huge base of everyday customer deposits costs very little. When the main ingredient, money, costs less, your profit margin is bigger. Also, there's how well they run things. Even though some parts like investment banking naturally cost more, think banker bonuses, the bank as a whole is a very efficient machine. 2. Switching costs. The more products you have with JPM, the harder it is to leave. Think about all the work: changing direct deposits, automatic bill payments, linking cards. It's a hassle. Fintech companies try to focus on small areas, but JPM offers the whole package. 3. The real game changer: scale and scope. This is the most important part. JPM's size isn't just about being big, it's about what that size lets them do. JPMorgan's technology budget, over $15 billion, is 50% bigger than its closest competitor. It employs tens of thousands of tech experts. While smaller banks struggle to update their old systems, JPM is putting a lot of money into AI, going digital, and automation. They're building one smooth, connected digital platform for all their services. This ability to invest more than everyone else, year after year, makes the gap between them and their competitors even wider. Fintechs can be quick in one small area, but they don't have the money, the customers, or the banking license to compete everywhere. Financial strength and profit drivers, the numbers and the future. A strategy is great, but what about financial health? JPM is seen as a safe haven. Capital ratio, CET1, 14.8%, at the end of the third quarter of 2025. Minimum regulatory requirement, 12.3%. What does this mean? The bank has much more capital than regulators require. It's a strong safety cushion. Because it's the most important bank in the system, GSIB, it has the highest capital requirements, and even so it has plenty of extra. Now, let's look ahead. What will drive profits, or not, in the coming years? 1. Net interest income, NII. JPM has greatly benefited from high interest rates. Now with interest rates expected to fall, this financial margin, NII, is projected to face some pressure. The bank is asset sensitive. 2. Fee income. Here, the outlook is positive. The acquisition of First Republic has structurally strengthened wealth management revenue. Solid growth in service revenues is expected. 3. Expenses. The point of concern. This is the big discussion. JPM is spending a lot on technology and expansion. The text's projections indicate that 2026 will be the peak of these investments. The idea is, spend now to gain efficiency and revenue growth later. 4. Credit costs. Credit losses are expected to be a bit higher, going back to normal after very low levels post-pandemic, but nothing to worry about, given the bank's careful risk culture. The bank also has a clear plan for how it uses its money. About 30–35% of profits go to dividends, and the rest is put back into the business. What's left over is used to buy back shares. Bulls versus bears, the battle of stories. Like with anything, there are two sides to every story. Let's break down the arguments from the optimists, or bulls, and the pessimists, or bears. The bulls say, dominance. JPM is the most powerful and well-established bank in the United States. Its leading position in many different areas gives it a big advantage. Safety. You can sleep soundly. Their balance sheet is super strong, so there are no worries about people taking their money out or big problems with rules. Investing in the future. Their huge investments in technology and growing their business naturally will help them get even more market share in the next 10 years. On the other hand, the bears say, interest rates. Higher interest rates have been great for their income, but it's a double-edged sword. If the economy slows down and rates drop quickly, their profits will suffer. Return on investment. Are these massive investments in growth just a blank check? There's no guarantee how much money they'll make in the future, or when. It's hard to predict the return. Costs. Out of control? It's possible that the peak spending expected in 2026 might not be the end, and unexpected negative surprises in expenses could still pop up. Risks, management, and capital allocation. Risks and the Dimon factor. No investment is completely risk-free. For JPM, the main risks are: 1. Regulatory and macroeconomic risk. As the biggest, JPM is always the main target for regulators. Fines and compliance costs are high. Plus, the bank relies completely on interest rate cycles and the health of the economy. 2. Technological disruption. Fintech companies are always coming up with new things. Even though JPM's size is a big hurdle for them, the risk of being outdone in specific areas by more agile companies is real. 3. Governance risk, ESG. Banks are always being watched closely for their lending practices. Even with these risks, our analysis rates JPM's uncertainty as medium, because its huge variety of income sources makes up for how complicated the business is. And we can't talk about JPM without talking about its management. The bank's capital allocation is rated as exemplary. Led by the legendary CEO Jamie Dimon, the bank not only survived the 2008 financial crisis but came out stronger. The management has a history of avoiding bad products, making smart acquisitions, like Bear Stearns and Washington Mutual during the crisis, and First Republic now, and investing in the future. The bank is on the attack, growing its presence, and getting ready for what's next. The First Republic acquisition is a perfect example. They bought a high-quality wealth management portfolio at a great price. Conclusion and thesis summary. So, what's JPMorgan Chase's investment thesis in a nutshell? JPMorgan is a fortress. Its competitive edge comes from a mix of cost advantages, cheap deposits, and high switching costs for customers. But its main differentiator is its unmatched scale and scope. JPM uses its massive profits to invest in technology, over $15 billion a year, at a level no competitor can match. This creates a virtuous cycle. Technology improves the platform, attracts more customers, who bring more deposits, which funds more technology. Today's investor is paying for a bank that's in the middle of a heavy investment cycle. The bet is that these short-term expenses, which put pressure on costs now, will lead to even greater market dominance, efficiency, and revenue growth in the long run. The risks are clear: an economic slowdown, a sharp drop in interest rates, or these investments failing to pay off. But JPM plays a long game, solidifying its position as the central bank of the American financial ecosystem. What about you? What do you think of JPMorgan? Do you see value in America's biggest bank, or do you think the risks of regulation and competition are too high? Let us know what you think in the comments. If you like this analysis, don't forget to hit that like button, subscribe to the channel, and turn on notifications so you don't miss our next videos. Thanks for watching, and see you next time.